Welcome back from lunch. I'm sure you enjoyed your lunch. Now we can get back to work. So we concluded our session by looking at the financial performance. In which area? Let's just remind you. So in our financial analysis or financial performance, what have we dealt with? We have dealt with that, and we have dealt with that. Now we want to deal with this. So this is where we are. Now I want to deal with the concept of the divisions. So let us now look at the concept of the division. So we start with the concept of the division. So coming to our exam, when we divisionalize an organization, the syllabus wants us to be able to talk about responsibility accounting. The syllabus wants us to talk about the division performance measures or the KPIs, the relevant KPIs. And the syllabus wants us to talk about transfer pricing. So when you're preparing for the exam, this is your checklist. You want to make sure that you are comfortable with the responsibility accounting. You are comfortable with the KPIs. You are comfortable with transfer pricing. Okay. So let's talk about these items here. Responsibility accounting. What is a responsibility accounting? What is responsibility accounting? What can you say about the concept of responsibility accounting? Well, responsibility accounting involves splitting an organization into responsibility centers. Why? The answer is performance. We can improve the performance of our organization by introducing a system of responsibility accounting. So what is involved in responsibility accounting? Responsibility accounting involves taking the organization, this is the organization, and you split it up into smaller units. These units are what we call responsibility centers. The first step in responsibility accounting is to split your organization into smaller units. And these units are what we call responsibility centers. Why do we split the organization into smaller units called responsibility centers? What do you want to achieve by this process? Well, you want to enhance the performance of your organization. You want to improve the performance, and that's a theme that we've been carrying since morning, that APM is about improving performance of the organization. So you want basically to improve performance. So the thinking is that if we run our organization as one big unit, if you say, let's run this organization just as one big unit, it will be very difficult for you to go forward. A number of us may be familiar with agricultural activity, farming. Now, I don't know, we have the whole range of people in this call coming from different parts of Africa. But in the southern hemisphere where we are, this is the agricultural season now. So people around here would relate to this well. If you go to a field, and you say, there's 20 of us, let us plow this field, want to plow this field. And then we tell ourselves, how are we going to approach the exercise? Then we say, okay, let's all of us just start attack the field like that. Let's just be moving like that. Everybody, let's just come and we start attacking the field. Then we'll see what will happen by lunchtime. That model may be dangerous for us because we may not know who's working and who's not working. Attacking this field in this fashion may not give us or guarantee us good results. So how can you get good results? Responsibility accounting says what you must do is you must take this field and split it in smaller units called responsibility centers. And these responsibility centers, you must assign them to responsibility holders. You assign them to responsibility holders. So each one has got its own responsibility holder. Now accountability starts because there's a responsibility holder. When reporting comes, we're going to prepare a report on the basis of each one of these responsibility centers. Now I've got a good performance report coming out, which is responsibility center burst. I'm sure, in all fairness, you agree that this system is much better than the one we started with here. So every responsibility holder want to see how much work are they doing, because at the end of the day, they're going to submit a report, a performance report. These responsibility centers can be run as revenue centers. So examiner wants you to understand the difference. So these can be run as revenue centers. We can run them as cost centers. We can run them as profit centers. We can run them as investment centers. That is how we can run these centers. So this system of responsibility accounting, where we create responsibility centers, assign them to responsibility holders, and at the end of the day, preparing a performance report on the basis of the structure of each center is likely to improve the performance. Let us now come to the performance reports. Let's talk about performance reports. Let's talk about performance reports. In the revenue center system, the responsibility holder has got one task: revenue generation. In the revenue center system, the responsibility holder has got one task: revenue generation. So we're going to give him a target of how much revenue he must generate every week. At the end of the day, he's going to do a report showing the revenue generated, and we compare it with the target, and we see where they are down, where they're okay, and discuss accordingly. So the KPI then that we're talking about is a variance report. The KPI will be a variance report, which compares what? The actual revenue and the target revenue. Actual revenue against the target. Secondly, other than revenue, we've got the cost center. Here, the manager does not generate any revenue because of the nature of the center. All he does is he spends. So if your responsibility centers are modeled on cost centers, it means they're simply spending units. How do you control the performance? How do you monitor performance? We're going to give them a cost budget. We're going to give them a cost budget. And this cost budget that we give them, the managers are supposed to spend within the budget. And if they overspend, well, the variance will show it to be adverse. So in terms of the KPI then, in terms of the KPI will be the cost variance. And the more meaningful variance is the one which is broken down. Instead of giving us a block variance, a good performance report is going to go line for line, showing us what the budget was, what the actual was, what the variance is. So we want a breakdown of all the cost elements. So we want cost elements properly broken down. And this will be our report. So the performance report will be a variance analysis report, broken down as much as possible. We want a all broken down report. So I hope you're able to pick the concept of a performance report and the KPI. Further, when we report variances in a responsibility center system, when we report variances, we want to show controllable and uncontrollable variances. In other words, these variances here must be those that are within my control. Don't give me variance over which I have no control. And it would be nice if I also have a say in the budget. And also here, you must include items for which I've got control. All the items which are not within my control, remove them from this list. Now remember that on APM, your work is to evaluate performance reports. So one performance report we can ask you to evaluate is we can give you a variance analysis report and ask you to evaluate. So the point of evaluation would be, first of all, this list. Does the person have control over the whole of this list? Does the person have the control over the full cost? How are budgets set? Have they been updated or these are out of date? What are you doing? You're evaluating a performance report in the call center system. Let's come to a profit center system. Let's come to a profit center system. Now in a profit center system, this is where our current examiner is interested in. Let us do a bit of work on the profit center system. Let's do a bit of work on a profit center system. Let's do a bit of work on a profit center system. Okay, so if we are operating a profit center system, if our responsibility centers are profit centers, if you give me something like this, and I ask you to evaluate that. Let's evaluate this report. You can say that this report is the profit center. Well, it's okay because in a profit center, the manager there has got control over, or he's got authority, or he's going to be given a task to generate revenue, but also he does spend. So if we're evaluating this report, you can say the strength is that the report is very straightforward. It's easy to show that our manager generated 100 revenue and incurred 80 costs, and he has a profit of 20. What are the weaknesses? A good performance report must observe the concept of controllability. The issue of controllability has not been observed here. Is this manager answerable for the whole of that cost? We can't tell. So we want a report that can show us controllable and uncontrollable profits, controllable and uncontrollable costs. That's the report that we want. So this report here, we're saying it's got a weakness. So one, a good profit center report must show controllability, and also it must separate performance of the manager and the center or division. These are the 2 points that we want to make sure that the report shows. These 2 points must be observed. If they're not observed, then we are saying, no, the report is not very good. A good report must separately show the performance of the manager and the performance of the center. That's what we expect. So this report has a weakness because it doesn't show us that. So then, what have we seen in the recent exam? Well, it's 2 items. Let me share some items. Okay. So let me share that item there. In the recent exam, we have seen a question on profit centers and responsibility accounting, which wanted you to demonstrate knowledge of a controllable profit and the traceable profit. So what's the difference between a controllable profit and a traceable profit? The impact of controllable costs and traceable costs on division profit could be viewed as follows. So this is a good performance report because it has demonstrated the concept of controllability. It has also separated the performance of the manager from the performance of the center. How? Let's go and explain the 2 items. So these controllable costs, divisional costs, are those that the manager can control. He has a say. He can authorize. He does authorize them. He approves them. So once we have got the revenue minus controllable divisional costs, we arrive at controllable profit. However, there are some costs over which the manager has got no say. These costs are decided upon by the head office, but they represent the resources that are being enjoyed by the manager, by the division. These are called the traceable costs. So in a good system of responsibility accounting, we must show the traceable costs. For instance, here's depreciation of a vehicle. Depreciation of a vehicle. This vehicle is bought at the head office. Head office is the one that bought this vehicle, but it's being used at the division. That depreciation can be traced, although it's not a controllable cost by the manager because he didn't make that decision. It was made at the head office, but still the cost can be traced. And that's what we call a traceable cost. So once we knock off the traceable costs, we are about a traceable profit. This traceable profit is the one which must be used to assess the performance of the division. This must be used when we're talking about the performance of the manager. So the performance of the manager should be separated from the performance of the division. The manager must use a controllable profit. The division must use a traceable profit. Now, apportioned head office costs, this does not represent the resources being consumed by the division. These are resources consumed by the head office. And then we find the net profit. This cannot be used for appraising the performance of the manager or of the division. Now, this is the type of question you can get on responsibility accounting. So here, you must understand what's the cost center, what's the revenue center, what's the profit center, but more importantly, the KPI. The KPI is associated with these type of centers. So that is the concept there of responsibility accounting. Let's continue now with our discussion. What of an investment center? What of an investment center? What do you expect an investment center situation? In an investment center, the manager has got wider responsibility because he is answerable for the revenue generation. He is answerable for the cost. And he is answerable also for the investment in assets. The manager is responsible for all these. So therefore, his KPI must reflect the fact that he does have a say also on the assets. And therefore, what can you use? You can use a ROI, return on investment, or you can use RI, residual income, or you can use economic value added. You can use economic value added. So when you look at our exam, we have seen all these items, and in the recent exams, the examiner has examined EVA quite a number of times. The examiner has examined EVA quite a number of times. So let's talk about EVA. Let's talk about EVA. So of these KPIs, of course, ROI is important. So advantages and disadvantages. RI also advantages and disadvantages. And then we've got EVA. And EVA is quite common on this paper. EVA is quite common on this paper. Let's remind ourselves of EVA. How does EVA look like? EVA is useful not only at divisional level, but useful also at the company level because of the concept of value. Because of the concept of value. So let's talk about it now. So that is our EVA there. Net operating profit after tax less the capital charge. What is the capital charge? The capital charge is the weighted average cost of capital multiplied by the capital employed. What do we need to calculate the WACC? Let's remind ourselves of the WACC. To calculate the WACC, we need three variables. What are these variables? We need the cost of equity. We need the cost of debt. We also need the value of equity, market value of equity, and also market value of debt. So once you have the cost of equity, cost of debt, the market value of equity, market value of debt, then we can calculate our WACC. So in our exams, we have seen that we have to calculate the WACC. We have seen that we need to calculate isn't it? What trick are we seeing in the exam? The cost of debt must be after tax. This cost of debt that we have here is after tax. That's a major trick. Let's talk about capital employed figure. What capital employed figure do you use? So I want to discuss the capital employed figure. What of NOPAT? How do we get NOPAT? We need to make some adjustments. So let's talk about some of the adjustments that we need to establish net operating profit after tax. Yes, to calculate NOPAT, we take your operating profit, which is our profit before interest and tax. If we start with that one, we add back accounting depreciation. If there's any increase in the provisions, those provisions that we make as accountants, we need to add back because that does not represent a cash flow. If there's any non-cash expenses we had knocked off, please put them back as well. Advertising, research, development, and employee training costs, all these we add back. Want to get a figure which is as close as possible to a cash flow figure, what we call an economic profit. So we add these figures. However, must remember to knock off some items. What are those? In place of accounting depreciation, we bring in economic depreciation. That one, we remove it. If the question is silent, doesn't give a separate figure for accounting and economic depreciation, if no separate figures are given, assume that the figure is equal. It's the same. So don't make an adjustment. Unless where a separate figure has been given. If there was a decrease in provisions, which had been reported as part of the profit, you know, when there's a decrease in provision, you remove it because it had increased our profit. Now, those costs that were added back, advertising, research, development, and employee training, we don't forget about them. No, we don't forget about them. We start doing what? Amortizing them slowly. That's what we do. And where the basis has been given, we also depreciate that component over the period of time. Then we bring in the tax. This is a tax paid. So we go for a tax that was paid. Now, this tax that we pay normally is reduced because of interest. So that tax relief on interest, which is interest on the tax rate, you must add it to this. So the tax paid, you pick it up, and the relief, the tax relief on the interest. So this becomes a full tax expense that must come here. That will give you an NOPAT. After you've done that, what happens? You are home and dry, you've got your work. Now let's talk about the capital employed figure. So what figure do you use for capital employed? It's the opening balance. Opening balance. Opening balance. So the opening balance is what we use. Meaning, if we are doing EVA for 2022, if we are doing EVA for 2022, year end 2022, we're going to use the figure on the 1st of January and not a figure on the 31st of December. So if we are calculating EVA for 2022, the capital employed figure is this figure here. That's what you take. Do you adjust this figure? Do you make an adjustment in this figure? The answer is yes, you do. What do you adjust this figure for? If there's any items in the previous year, before 2022, this side, before 2022, if you have got any items before, which should have been added or subtracted using EVA, we must do it. So if there was issues such as the marketing costs or R&D, which had not been added back, we're going to take our opening figure here and adjust. So don't adjust for items in this year. Don't adjust for anything here, because us want this figure here. So if we ever adjust this figure, look at it. Is there anything that should have happened before this date, according to EVA? Oh, yes, there is. You identify those items and add them back. You identify those items and add them back. Okay, now there's a question. Let me attend to a question here. There's a question. Where is the question on the charts? Can you please show the previous slide on adding depreciation, increase in provisions? Okay. Can you please show that? Yes, why not? Yes. Let's go. Here we go. So we go. Accounting depreciation, you must add it back because it's taking that accounting depreciation is more theoretical. It's more mathematical, doesn't really reflect what has happened to the asset. So add it back and replace it with economic depreciation. If in calculating our profit, we had discharged a provision, an increase in provision. Remember, when there's an increase in provision, it's an expense. That expense does not represent money. It is us accountants who have created that expense. So we add it back here. So somebody had asked me to comment on that. There was a comment that, please, can you show us that? There's also a reminder that I must share the slides. Yes, we'll share it with you, not a problem. We'll share the slide and share the presentation too. It's being recorded. Okay. Good. Thank you very much for the accolades, for the credit. There's nice feedback coming that we are enjoying it. Please, I'm very happy to hear that. I'm also motivated to do much more for you. We'll see what else we can structure for you outside this. Huh? Yeah. So Eva has been coming. Where has been problems? Well, the problems have been on items, including the cost of debt. Sometimes we fail to remove the tax. We don't remove the tax. So that is one problem. The capital employed, the another problem could be the capital employed figure. So remember, capital employed figure, if we are doing it EVA for 2022, if the year is 2022, that one. So on the 31st December, we say, let's calculate the EVA at the end of the year. So this year is like that. That one is 1st of January. That one is 31st of December. So it's here that we want to calculate the EVA. Have we generated the value this year or not? So what we are saying is that for NOPAT, you look at it, the profit that you are reporting here. So that's the figure that you use. So from the figure here, you do your adjustments and get your NOPAT. That's what you do. So you look at it, the profit generated this year, all the profit which you have reported there. You take that profit figure, which is this one, and make these adjustments that we're talking about here. These are things that happened during this year. That's the point that I want you to pick. These adjustments that we're talking about, all these adjustments, they happened within here. So we're talking about the depreciations, research and development within 2022. For capital employed, you pick the figure here, which is coming from 2021. That's the figure you take. This figure, does it require an adjustment? The answer is yes. If there's anything which are EVA items, which were not done in 2022, in 2021, even before 2021, in 2020, 2019, if there's anything that was not captured because we're not using EVA, we are saying we're going to take note of all those and adjust this figure accordingly. Do not touch items for 2022. here, don't touch them. Leave all the items here, don't touch them. The only items that can change your capital employed are items before. That is the other problem we have. And the good news is that in the exam, we are not going to get a lot of adjustments. There are just a few adjustments. Just a few adjustments that you're going to get in the exam. Not everything, no. Just one or two items, that's all. Okay, let's make a move now. Let's come back and make a move if that is okay. Let's make a move. So this is the concept, people. That's the concept that we are looking at of EVA. Okay. Now, what we're going to do is we are going to allow you try out a question. We'll allow you to try out a question. And the question that will allow you to try will have both items, some of the items that we covered in the morning and the items that we are talking about. Okay. So that we conclude this particular item of divisional performance. That's what we are going to do. Okay. So if you're looking at our activity schedule now indicates that we're supposed to try out a question. Okay. So for the next 1 hour, we work on a question, finish the question. Then after that, we take a little break. Then we review the question before we can look at the public sector issues and also the private sector issues and our concept of the models. Okay. So that's what we are going to do. I'm going to throw a question paper on the forum. And once I throw the question paper, all of you in your wherever you are from locations, you're going to answer the question. After you've answered the question, then we come back. I've removed transfer pricing from this series. There are a few topics that I'll do completely separately because I know that students need a lot of help. Example, risk and uncertainty, I'll do it separately. Transfer pricing, I'll do it separately, and there will be more or less complete discussions. Risk and uncertainty and transfer pricing, I'll make them complete discussions because I know that students have got quite challenges with those two. So I won't gloss over them, I'll run through them quickly. I'll do those two in the next block that we'll do. Okay, so there was a good reminder that I haven't touched transfer pricing. Don't panic, I'll do those together with the risk and uncertainty. So now what we want you to do, we want you to practice a question on evaluating a performance report and also on the concept of economic value added or EVA. And afterwards, once you log back, then we run through everything and then we'll be concluding for the day. Okay. So I hope all of you are on our forum so that I hope all of us are on the forum. Is there anyone who's not on the forum? So let me throw our work on the forum so that all of us can capture it. Okay. All right, so let me. So just 1 minute, let's